Hello and welcome to the Chamber Music Mindset. I am your host, Anna Rathbun. We have three different topics to cover today. Market update, as usual. And then the second topic is Bitcoin and some crypto assets. It's been making the headlines and moving the markets lately. So I do want to talk about Bitcoin. And the third topic I want to discuss today is private credit. That is a topic that I have purposefully not talked about in these videos. But I think there's enough confusion out there and a lot of hype out there. So I do want to address it. But before I begin, there's the usual disclaimer, which is that nothing you hear in this video is investment advice. Everything is for informational and educational purposes only. And frankly, it's just all my opinion. Now, before I begin, I want to give a shout out to a particular viewer who has been very kind to give me tips on how to make these YouTube videos more friendly to the viewers, as well as to help me to build the audience base. You know who you are. Thank you so much. And I'm going to take these suggestions. So I'm going to ask you to like this video and to subscribe. If you like what you hear, please subscribe, because I do intend to do these on a weekly basis most of the time, except for next week. We're skipping next week. This has been a passion project of mine. You know, before I started Granadilla, I spoke at a lot of different events talking about the economy and the markets and capital movement, invited as a speaker. And one of the things that I found out was that there was a lot of confusion about what was going on in the world. And I liked explaining things. So you don't have to be an audience member at one of these speaking events, but all you have to do is subscribe, tune in, and hopefully like my videos to get a balanced view of what is happening in the markets, what is happening in the economy. I do not have an agenda. I just want you to know some facts. I want you to know the history when it's applicable, so that you can make up your own minds and your own decisions on things that impact your life. So, okay, that was a long intro. Let's get started. Market update. Thanksgiving week was a positive week, thankfully. You know, after a negative week, that's what we had the prior week, it's always nice to have some comeback. It's always nice to have a little bit of rebound and see that there are buyers who are still willing to buy the dip. So last week, S&P 500 index returned 3.74%. Russell 2000, which is a small cap, returned 5.55%. So as I've said many times in this video series, when small caps rally and rally hard, that means that buyers are a little bit more friendly to taking more equity risk. So there's a risk-loving sentiment that is prevailing in the markets, at least for that week. Now, I will say that trading is pretty thin during Thanksgiving week, because a lot of people are taking holiday. So things tend to move around a bit. You know, even if there aren't too many buyers, it'll go up because there aren't too many sellers countering it potentially. So take it with a grain of salt. And certainly the way we started December has brought us back to reality. But what moved the markets last week? What was the news? It could have just as easily gone down, right? There were some doves, meaning Federal Reserve doves, people who on the Federal Reserve would like to see interest rates go down, not the hawks. They came out and started talking. So it felt like last week, the dovish sentiment went up, hawkish sentiment went down. Remember, the week prior, it was the opposite, right? The hawkish sentiment was up. A lot of Fed officials were coming out and saying we should hold, or we should favor to hold because we don't have a lot of information from the government. All of those things, valid reasons, but whether they would hold or cut, you could go either way. I mean, you could argue your way to a rate cut. You could argue your way to a steady Eddie, not doing anything. The data can point to either different direction. But last week, the doves won out. There was a lot of talk about supporting the economy with lower rates, and that made the markets very, very happy. Now, since then, we've had a little bit of a rocky start to December. Today is Tuesday, December 2nd, after hours. So we had a negative Monday and then we had a positive Tuesday. So it's a little bit, the markets really can't make up its mind. It's been a little bit rocky because there isn't any reason for the market to decide on a direction. And I think it's going to be like this for a while. That is my opinion because, and maybe if the Fed cuts in December, which is coming up, the markets will go up. But right now, we don't know what the Fed will do. Yeah, there were doves, but there were also hawks. And we don't have enough information about inflation or the labor market from the government because it was shut down for so long. And the Fed is not going to get labor market data before they have to make their decision for December. The labor market data that would normally come this Friday, we're not going to get it for November because when they do the surveys, which is the first 12 days of the month, we were pretty much shut down. So this is really up in the air. It's a coin toss. The markets really don't know which direction to commit to. All right. Now, the next thing I want to talk about is Bitcoin, because the Bitcoin movements have been sort of dictating how people feel in general about the markets. Remember, the stock market is often driven by sentiment, not necessarily by fundamentals. Even when earnings come out and it's great, the stock may go down if the expectation was even higher. And the good results, actual results, were below expectations. You could see a sell-off. So that is clearly dependent on expectation and the sentiment around it. So there's a lot of emotion riding on the stock market. So Bitcoin, which is in some ways pure emotion, right? Because there isn't any asset at the core of the Bitcoin trading that has intrinsic value. And I'll go into that in a little bit. So what's happened is Bitcoin has been falling since, a little after mid-October, and it's gone down something like 30%, right? So that has spooked investors. Now, Bitcoin has nothing to do intrinsically to, small caps, or some do, but like industrial companies, but they all went down because of emotion. So what's going on here? In my opinion, Bitcoin has multiple personalities, and that's because it's a fairly new asset. When Bitcoin was invented back in, 2000s, but its popularity really started to arise in the last 4 years, right? So when Bitcoin started to really take off, it really took off, right? So because it's such a new asset, it's very difficult to understand exactly what asset class it is and how it moves, how it behaves, and also how it behaves in relation to other types of asset classes, how it moves in relation to currency, how it moves in relation to fixed income or stocks. We just don't know. Because right now, so far in the last 4 years, it has had multiple personalities. And what do I mean by that? Sometimes it's viewed like a tech company. It's a proxy of the tech sector, the tech sector. And it's true, for a while, like 2021, 2022, it moved along with NASDAQ. The correlation between Bitcoin and NASDAQ was like 95%. So it moved like a tech stock. But sometimes it's seen as a blockchain proxy. So what do I mean by that? Bitcoin and a lot of crypto assets are actually grounded in that blockchain technology. So some investors viewed it as a blockchain proxy. If I want to invest in blockchain and I don't have access to private investments that are putting money directly into the blockchain technology, Bitcoin is my proxy. So some people viewed it that way. Sometimes people view it as currency, a currency proxy. A lot of people believe that the US dollar it's in its last days, which that's a completely different video for a different day. That is not true. But still, when we have debt that is up to $37 trillion, you get a little nervous if you're an investor, right? So a lot of people view Bitcoin and other crypto assets as a currency proxy to the US dollar, something essentially, quote unquote, safer than US dollars. Some people view it as a safety proxy, right? So again, going back to that debt profile of the United States, if we have $37 trillion in debt, what value is our bond, right? Fixed income. For example, if I had a crazy amount of debt compared to my balance sheet or my cash flow, then would you lend me money without charging me a huge interest rate? No, you would want to be compensated for the risk you're taking by lending me money. Sort of the same thing. So some people have started to view US Treasury bonds as a little bit riskier than they historically have been. Historically, it's a risk-free asset. It still is. But if you believe that, then Bitcoin was sometimes used as a proxy for safe assets, which is funny because if you are correlated with NASDAQ, how could you be a safe asset, right? So again, multiple personalities. And finally, just in the last few weeks, it's been viewed as a risky asset proxy, sort of like NASDAQ, but now it's not just NASDAQ, it's the entire stock market. A few weeks ago, I did an interview with Reuters. I do these once in a while, about once a month. And one of the questions was about Bitcoin because it was selling off. And, investors want to know, is this, foreboding of a huge stock market sell-off? And my answer there was, yeah. I mean, it could be, right? It could be. Crypto is pure emotion. And I said I would talk about this. It's pure emotion because there's nothing inside of it in terms of intrinsic value. You could say it's tied to the blockchain, is its intrinsic value, and that's a different discussion, but the coin itself does not, right? So it really is, the price movement is a function of supply and demand. And supply and demand is driven by emotion. Do I feel risky or do I not feel risky? Do I want to, sell it and go into safe assets, safer assets? So to me, it is pure emotion. And now stock market is also driven by emotion. So yes, there could be a correlation, and that is what we have seen. But unlike crypto, the stock market has intrinsic value because it is stock or equity of underlying companies that actually have cash flow. They have things to sell and services to sell. That is its intrinsic value. Okay. Sometimes crypto is seen as a commodity. And commodity, if you think about it, well, okay, so it is trading like commodity. Gold is sometimes very volatile, contrary to popular belief that it is this asset that holds its value forever. It holds its intrinsic value forever. Gold is a precious metal, but the price of gold can go up and down. It could be very, very volatile. And same thing with crypto, right? But gold at least has intrinsic value. It can conduct electricity. It's precious metal, so it has value in our society. Copper can conduct electricity. It is used in industrial, endeavors. These things have uses, right? Crypto doesn't, at least not one that is accepted by our society that can be used universally, right? So it's not even really a commodity either. Anyway, so what is your identity, crypto? I don't know, because you keep changing your mind. Okay, so is crypto then absolutely useless? No, because despite its rocky movement in the last few years, and I think actually also before that, but certainly in the last few years, there's been more adoption by institutions. What do I mean by that? Large institutions like universities, endowments, foundations. These institutions are actually have been buying crypto to keep as a part of their asset allocation. I'm not saying that you should. I'm just telling you that this has been happening. And what they have done is to buy crypto on the blockchain and to keep it in cold storage. They're looking at crypto as a store of value, which is one characteristic of a currency. Okay, so it doesn't return you anything. It doesn't have cash flow. You can't use it in an industrial fashion. It's just storage of value. Now, that value moves around a lot because it's volatile, but they do keep it as storage. We have seen that happen. And when institutions use it that way, it probably won't go away very easily, but it will be volatile. That is the one thing that we know, because it is at the whim of people and their emotions and their sentiments around anything, really. The latest I heard was, I couldn't believe it when I heard it. So McDonald's brought back its McRib, which ironically I used to like when I was younger. I don't like it anymore. And apparently somebody pointed out that the introduction of McRib it coincided with crypto going up, the value of crypto going up. Apparently it came out and people were raving about it, this correlation, but false relationship, right? Now, that tells me everything about just how crypto is sentiment driven, right? Apparently McDonald's brought it back and Bitcoin has just been going down. So false relationship, only a correlation, not causation. So it's here to stay, most likely, but it will be volatile. And markets may move around with it. And at some point, that correlation is expected to break as well, because if the short history is anything, the other correlations have also broken. Let's talk private credit. I have come across, and frankly, my friends, family, and people I know have been sending me articles, videos about potential dangers of private credit. And frankly, some articles are smart and they're just pointing out some things that we're all observing. But especially on the video side, there seems to be a lot of hype. So I just want to sort of separate the facts from predictions. Let's just separate them. So, what is private credit? Private credit is lending that is done by an institution that's not a bank. So it's not regulated by like a bank, which makes certain people nervous. It is private money, so there's no public data on this. It is very private. And these institutions oftentimes are big private funds. So I'm sure you've heard of names like Blackstone, Ares, Blue Owl, etc. These are a few of the players. There's a lot more. And I'm sure you've also heard of BlackRock. That name has come up multiple times. They serve a function. They're not evil. They serve a function. What do I mean by that? So take yourselves back to 2007, 2008. So 2008, 2009. This is when the global financial crisis happened. And when you have a credit-driven downturn, and what do I mean by credit-driven? We gave out so much credit through mortgages, willy-nilly, right? There was no discipline behind that, which is partly what caused it. And then, of course, the ratings, another story. Because it was credit-driven after the crash, trusting people became very difficult, right? So it was hard to get a mortgage. You had to prove everything and provide so many documents, which is probably what should have been done all along. But anyway, and banks were not willing to lend. And on top of that, there were a lot of scrutiny around the banks because, frankly, the banks were not well capitalized, right? So there was a lot of pressure on the banks to make sure they have enough liquidity, that they're sound and they can actually serve the public while still lending very, very carefully. That meant that liquidity for everything else dried up. Okay, so this is when private credit, which had existed all this time, sort of flowered. So a lot of private credit assets had been lent out to small businesses and businesses that could not get loans from the bank. Sure, you have to pay a higher interest rate, but if you want to build a business or you want to do anything, expand your business, CapEx, whatever it might be, you needed the capital. So you were willing to digest the higher interest rates. Okay, so for liquidity into the economy, private credit played a big role. From then, private credit just grew and grew and grew and grew. Okay, and then the pandemic happened in 2020, and then it ballooned even more. Before the pandemic, my friends in the industry and I used to say that private credit was very frothy. This was before the pandemic. And now I don't know if there's a word for beyond frothy, but so a lot of capital has gone into it. Helping this situation, hi Lucas, helping this situation was the fact that a lot of private credit funds then went to find investors in the private wealth space. So I know private credit managers very, very well, how to diligence them, et cetera. And they're reaching out to the retail investors, private wealth investors, so that they can actually participate in these investments. Now, anytime money flows into something, a lot of money flows into something very quickly, people get nervous, and they have every right to. People get suspicious. I get suspicious anytime capital is chasing something. Why is that? Because when a lot of capital goes into something like a fund, and those fund managers have to deploy that capital and invest it on behalf of the investors, and there's just so much capital to deploy, then sometimes you might put money into something that may not be super duper top tier, right? I'm not saying that they're doing that necessarily, but it is just human nature. And that money has to go somewhere, right? It can't just sit as cash. Investors gave it to you or put it into your fund so that you can lend it out. So you have to make it work. It's basically, it's a numbers thing, right? Not all companies are top tier, right? So inevitably that can happen. It can happen. So that's one of the worries. And of course, back in, was it September oh no, it was in October. CEO of JP Morgan came out and talked about cockroaches, referring to Tricolor, which was a subprime borrower car loan company that went bust. And JP Morgan had some assets in it. Sometimes these things happen. Not everything you invest in, not every endeavor you do in your life is going to be a home run. Sometimes in a big portfolio of assets, sometimes a few of them can go down. Okay, we can accept that. It's just life. But he called them cockroaches and it caught everybody's attention. And he said, when you see one, there's probably more. Well, fast forward to today and he was right. There are more. Hang on just a second. The joys of home videos. That was Stella barking at something. Sorry about that. He was right. JB Diamond turned out to be right because we did see more. So First Brands, it started out with First Brands, and then we talked about Tricolor, and there are others, apparently car washes and porta potty companies. I mean, there could be a lot of jokes around that. And my friends in Dallas, you may have been impacted by Renovo, home improvement company, another one of those companies that went down. So there have been some cockroaches. So what has happened is, when you have headlines like, oh, BlackRock writes down to zero this big investment in the, $150 million investment. I don't know if that was the actual number, but when headlines say things like that, people get nervous. How can $150 million go to zero? You have to remember that BlackRock manages trillions of dollars. And it is just life. Sometimes investments just go back, which is why you need to have a diversified basket of assets in your portfolio. It's another reason for diversification among many others. Ultimately, what people are afraid of is this sign of future ruin? Is everything going to go down? Part of this is coming from the 08-09 scare. That was really bad. And it was an actually bad event. And it took us a long time to get out of it. Whether through equity in your homes, which you lost, and hopefully you stayed in and then you recouped the losses because home prices are very high now, or through investments in the stock market. Or if you had a business, the economy was also very sluggish. It took us a long time to recover from it. And while that was, 15, 16, 17 years ago, if you are my age, you'll remember it. Even if you're younger than me, you will remember it. So this is what people are ultimately afraid of. I don't think so. If the market goes down, it might be because of a different reason or because of sentiment, right? Investors can get skittish when valuations are high. They can run for the hills. If that happens, it may have nothing to do with private credit. Let me tell you about private credit. When private investors lend money through private credit vehicles, they really get to know the owners. They talk directly with the owners. They really get to know their business inside out. They really get to know their balance sheet. They get to write their own negotiations, covenants, which basically means if you default on this loan, here are the recourse, steps that we can take. It's very, very long. And you get to actually have a say in that. Okay. And oftentimes they're backed by collateral, right? So there are ways to protect that investment. So in some ways, private credit is actually specialized, very customized loan to the business owner on behalf of the investors. So I think this idea that because a few investments went down, everything is going to go down, I think is hyperbolic. Okay. And there are a lot of people making good loans and injecting liquidity into the economy. So I also do not want to see private credit necessarily be demonized. There are things that are happening that do make the headlines that are a little bit tricky to deal with. I won't name names, but with publicly traded versus private business development companies, BDCs, there are some things that are making the headlines. These are not systemic. That's one thing that I think needs to also be understood. 2008, 2009 was a systemic event. It ran through the system. This is not necessarily the case because, again, the loans that are being made is customized between the creditor and the borrower. There are other reasons why people are worried about it, which I won't go into in this video because it's going to get too long. But those things, if the opportunity presents itself, and I think it's worth mentioning, I will mention it in this video. But for the time being, for all of the stuff that's out there about private credit and the reasons why people are afraid of it and people are drawing attention to it, I just needed to respond to that. So that when you see those headlines, you don't panic. You don't panic and sell everything or something like that. If you have an advisor, your advisor is going to tell you not to do that. But certainly it is not something to panic about. It's gotten so big, so it has been intertwined with other systems, and different regulators are recognizing that. I think some Fed officials have come out and talked about it. United Kingdom, UK, the Bank of England is also doing a stress test on private credit next year. So there are people who are coming out and trying to protect not only the industry, but also the investors and the systems at large. So this is not something that's going to come out of the blue. People are aware of it, and they are stress testing it to make sure that the financial system is sound. So that is all I have to say today about private credit. This is a very, very deep market. This is a very large market. It's not larger than US Treasury, but it is large market is becoming large. There are benefits and, things that are not that great about it too, just like any investment. And one more thing about private credit going into retail, there are pros and cons to that. You do have to do due diligence really well in order to pick the investment or the manager that is doing the lending. It can't be just any manager because there are people who've done this for a very, very long time. Like I said, it has existed for a long time. Some people don't think that private credit or private equity or anything like that should really be in the world of retail investors, the world of private wealth investors. But and I understand the reasons why. And myself being an advisor and being protective of my clients, it will, the due diligence level is very, very high, right? But I will say this: over time, the publicly traded market has shrunk, not in terms of market cap, but in terms of the number of companies. So Wilshire 5000, which used to have 5,000 companies, no longer has 5,000 companies. It has about 3,500 companies. So public markets are shrinking, private markets are growing. There's more than 6 million business establishments in the United States, right? And the public markets are participating in that and going into that. Public markets are shrinking, but only public markets are available to most investors. So there is a reason to be said, okay, we need to broaden out the investing universe for everybody, right? I'm not a fan of the term democratization of alts. I'm not. I used to be, but I'm not anymore because I think it's overused. So I will give you that information about the shrinking public markets and growing private markets and the access to these things to diversify your investments as a reason for having access to these. Maybe that is the same thing as democratization, but I do think that term is overused. Okay, that's it for today. I will not be recording for next week unless there is something huge that happens, and I'm hoping not, but I will be back the week after. So have a wonderful next 2 weeks. It is December, so please enjoy the holiday season if you celebrate it. Enjoy the snow if you're in a snowy area like me. Enjoy the sunshine wherever you are. And I will see you in 2 weeks.